Robin, how do you see gold being best used in client portfolios?
I think gold is quite a unique asset class. It has extremely low correlations to stocks and bonds. So we do advise client holding somewhere between 2 to 10% in a multi-asset portfolio, because that's been proven based on the last 55 years of data, it can actually improve the portfolio's risk-adjusted return.
And what issues are driving the most demand for gold at the moment?
It's a lot of issues. I think to name a few is the trade tensions, rising debt level globally, held by the government, the theme of de-dollarizations, less trust in the US government, the US dollar, and also inflation concerns. I would say those four themes has been one of the biggest drivers of gold prices this year.
And where does gold sit within portfolios, but also what do advisors need to think about when positioning it alongside bonds and cash?
So gold is an excellent diversifier. As I said, it's been proven hedge against equities and bonds. In fact, gold has extremely low correlations to bonds. So if a client have a typical 60-40, we advise somewhere between 2 to 10%. That's where there's a sweet spot where historically it has improved the portfolio's risk-adjusted return. We don't advise too much, so that would be a more tactical trade. But as a long-term strategic trade, 2 to 10%, it's an excellent range to have.
And how do you see gold performing in various scenarios looking forward in terms of, say, rate cuts or inflation persistence?
Yes, I mean, if we're talking about gold in US dollar terms, it's up close to about 40%. And that's been surprising to many, including us as well. But there are factors, there's a reason why gold price is doing well. We do foresee in our base case that gold price could hit close to 4,000 by this year. Because usually Q4, we expect a pickup in seasonality in terms of demand, both physical side and also in terms of investment through ETFs and futures. So we remain that the gold price should do quite well heading into 2026.
And what sort of feedback or pushback do you get from advisors when you're talking about gold and adding it to their portfolios?
So gold, I think one of the biggest pushback, it has no cash flow, no dividends, but there is plausible explanation because there's no credit risk in gold. So they don't need to pay a dividend or interest to compensate. I think the hardest bit is to convince the client that historically gold has been an excellent diversifier. It actually takes time for us to educate clients, including financial advisors, the role of gold. But I think once they're convinced, they see the results, and obviously gold price has been doing quite well in the last 2 years, they are willing to allocate maybe it's just 1 to 2%. But I think the general trend going forward is that we do foresee that more clients will probably uplift their allocation, maybe close to 3%, 4%, maybe in the future 5% as well. So that's the general consensus that clients do want to invest more in the future.
Robin, thank you.
Thank you, Drew.